Welcome, everyone, to the Keystone National Properties 1031 Exchange webinar. I'm Rick Kaplan from the New York Real Estate Journal, and I'd like to introduce our speakers for today. And up in your left corner, my left corner, Dan McDermott. He's the Regional Vice President for the East Coast. And Brandon Moreau, he's the Regional Vice President for the West Coast. And before we begin, I also would like to mention this is going to be on the NEREJ NYREJ podcast, and you can tell everyone that doesn't make it today, because I know this is going to be a long weekend. A lot of people are traveling this weekend, so they might miss this. If you want to enjoy this while you're sitting at the beach, you can listen to it on Google Podcast, Amazon Music, Apple Podcast, Spotify, and Buzzsprout, and I'm probably missing a few, as well as on YouTube and the nyrej.com /videos website. And I hand it over to Dan and Brandon.
Awesome. Thank you, Rick. Really appreciate your time this morning. We're going to go ahead and share some content that we have on our side. Get that queued up now. And let's go through here. Alrighty, we'll get started. This morning we just wanted to go in a little bit into an interesting tax deferment vehicle that we have. It's called a Delaware Statutory Trust. Most folks are probably familiar with the 1031 exchange model, where if you sell a relinquished property, you can exchange that into a like-kind replacement property, totally defer the taxes in that transaction. The Delaware Statutory Trust that we have just takes that a step further and provides a few different unique solutions as well that we'll dive into. One thing we always just like to get started with is, and the distinction that we like to make is, a Delaware Statutory Trust offering is actually considered a security through the Securities and Exchange Commission, and it is a private placement. So anytime you're considering an investment in a private security, it comes with associated risks that we recommend that you consult with a financial advisor or CPA if you're considering an investment. All right, so the agenda today, real quick, we're just going to jump into a couple challenges that we're seeing on our side. We work in the commercial real estate space all the time. We work with a lot of different parties in there, whether they're brokers, attorneys, financial advisors, actual investors themselves. Just highlight a couple challenges that we're seeing in the current marketplace. Next, we'll dive into what is a Delaware Statutory Trust, what is its uses, and any important information you should know about this offering. Last, we'll go into a couple reasons that you may possibly consider DST investment and incorporating those if you're working on a actual 1031 exchange in progress right now. And then last, we'll just jump into Keystone 1031 and who we are, what our history is, what our track record is, and kind of a little bit highlight of some of our offerings as well. So next, we'll dive into. So what are some current challenges that we see in the current real estate environment? I mean, I think the major theme here that we've all kind of experienced from watching the news and, working in the space is just economic uncertainty. Over the past, say, 6 to 18 months, you've seen bank defaults accelerate at a rapid rate. You'd see bank consolidation, notes for financing getting called early, rising in interest rates. It seems like every time the Fed now has a meeting, it's an interest rate increase. Along with those, what we're seeing on our side of things, and you guys probably are as well, folks that operate, in investment real estate, is increasing operating expenses associated with those. So now not only, do you have an asset that's producing cash for you, but, your costs of operating that asset are moving up over time as well. One thing a trend we're really seeing right now too is a lot of outflow and migration from politically unfriendly environments, towards real estate investors and landlords to more politically friendly environments. The rush of folks and exchanges coming out of the West Coast going to the Sun Belt is an example of that. Financing is an additional challenge that we're seeing. We're seeing financing become much more challenging to obtain, much more challenging to actually get a underwriting go ahead, and much more challenging to actually get to the closing table. The major thing that we're seeing too on our side is just a lack of surety that your under contract properties will actually close. Can you get those properties that you identify on a property ID sheet to the closing table and actually close on those within 80 days? We've seen that become extremely challenging over the past 6 to 9 months due to due diligence inspections, due to financing being challenging to obtain, due to rising interest rates, and actually obtaining attractive financing where you can actually pay for an investment to have it make sense. So that's one challenge, as well as what we're also seeing too, and this kind of leads into some of the migration that we're seeing occurring right now, is just we're seeing folks selling highly appreciated assets and politically unfriendly environments for landlords and moving them into environments that have lower cost of real estate. So what we see a common situation there is we see someone sell a $4 million building in, say, California, and they coming down to, say, Tennessee. All they can replace is 3.8. Well, what do you do with the last 200,000? Someone that is owning an asset of $3.8 million in value generally doesn't want a $200,000 single family rental in their portfolio. So what folks has traditionally done in the past is they'll just suck it up, say, I'll pay the taxable boot on this, and move forward. This is where one thing that a possible DST investment or consideration of one of these may be a parachute or a way to get you out of a situation where you could fully identify all your exchange proceeds and move those into a tax deferred state. All right, we'll go into what is a DST. So we'll go down to the slide right here. A DST is a Delaware Statutory trust, and when you really think about it, all it is it's an investment trust. The Delaware Statutory trust model has been around for near 100 years on the Delaware. Its use initially was for personal investment, private investments. The real advantage of what it came to be in 2004 is under 2004-86, the IRS gave a revenue ruling that said if you structure an offering with all the parameters of a Delaware statutory trust, it will qualify for like-kind replacement property and a 1031 exchange. So what that means for exchangers is now that you have an option in a 1031 exchange, instead of selling your relinquished property and identifying real property, it gives you the option now to identify a Delaware statutory trust offering that may own a portfolio of properties or a larger single asset, and defer, exchange those proceeds into that DST and fully defer your taxes. So we'll go back up here. One thing I always just like to go over to with the 1031 exchange timeline is that the things to always remember with the 1031 exchange is you need to flow all your assets through what's called a QI, a qualified intermediary. As soon as you close on a 1031 exchange, the proceeds will go to a QI. That is your day 0. The next day is day 1. So your first 45 calendar days, you have to identify 3 properties. Generally, it's 3 properties that you would like to replace in that exchange, and then you have 180 days to close on those properties. So where we're seeing currently in the market a lot of challenges that exchanges are having are in that 45-day ID window. Within that window, you need to identify properties, which means generally you'll need to do some due diligence on those to make sure you can get those under contract. They'd be desirable investment opportunities for you. So this is really where we can, provide some help, and a DST could provide some help as well. If you're getting towards the end of an ID window, say day 40, and you have, excess proceeds you can't place, or you can't find any, investment opportunities to put your funds into, this is where a DST investment may make sense, because it allows you, and a DST can be identified in as little as 24 hours and actually admitted into the fund, into the DST investment in as little as 24 to 48 hours. So I see that we have one question here real quick. All right, let me see here. Is my audio coming through any better? Can you hear me on my side? Okay. All right. All right, so we'll go next down into here. How is a DST investment different than from a 1031 exchange? And really, at its highest level, a 1031 exchange into real property or a DST exchange is almost identical in nature. The ID periods are the same. The requirements to use a QI are the same. And the 180 days that it takes to close on all those properties are all the same. What it really comes down to is, instead of identifying an actual real property address in an exchange, you'll identify a DST offering name that will actually own the underlying real estate. So as we can see in this example here, a typical 1031 DST exchange, you have the sale of investors' appreciated property. Those funds would flow to a QI. You would identify several different DST offerings. From there, you choose which properties you choose to invest in, complete some subscription documentation. The QIs will release the funds to the DST sponsor, and at that point, you'd be admitted into your DST investment. All right, so next we'll go into what are some benefits of DSTs. One of the major benefits of DSTs is a predictable income stream. One thing that we've seen, especially with economic uncertainty lately, is the rush towards more institutional grade credit rated tenants. So if you're selling, say, a strip center for $4 million, and you're tired of tenant turnover, working with LIs and TIs, to get things built out, what you can really do now is you can look at taking those funds from the sale of that, exchanging those into institutional grade real estate. Now, when I say institutional grade real estate, what I mean is, Firestone Tire, Walgreens, FedEx, UPS, credit rated tenants that have long histories of, surviving well under economic uncertainty and are very predictable in their income that they generate. So that's one of the benefits of it. Next is it's a passive real estate investment. So as one thing we see is generational wealth transfer goes on. Mom and dad owned a real estate portfolio, and now it's passing down to the heirs. They really still do want that allocation to real estate, but they don't want to be working in the day-to-day active operation in management of that real estate. DSTs give you an option where you can put those assets into a DST investment, still get the allocation towards real estate, but with none of the benefits, none of the downfalls of active management as well. The major benefit is still qualifies for defer your capital gains tax. It gives you the potential to as well to now vote with your feet, is what they say. So if you're selling a property, say somewhere that's undesirable for landlords, you can move that into a more desirable market. And with a DST investment, you can allocate them to many different investments. Minimums are typically around 50,000, so you could allocate that to several different properties and invest in many different jurisdictions. Last would just be it gives the ability to as well, once a DST, if the owner of the DST passes away, their heirs will get a step-up basis on that. So this slide here, we just like to jump into. This slide goes over what a typical leftover or excess proceeds might look like. This is an example Brandon and I see all the time. Say you're selling a relinquished property for $4 million. We want an investment condo for $1 million. Saying an industrial condo for $2.5 million. Well, what do we do with that last $500,000? The tax on that would be pretty significant and put a major drag on your return on the other properties. So now what you can do is you can possibly consider, if you're in a situation like this, okay, I'll put 500,000 into, say, a multifamily DST and 500,000 into a retail DST. So now, 250 in each. So now you've fully deferred all your exchange proceeds. You'll have no capital gains due through this structure, and you'll still get income generated from these as well. This slide, we just like to go in real quick. This just shows the difference between if you sell an investment property and you don't 1031 exchange versus if you do. So over here on the left, we see sale proceeds are $1 million. Net sale proceeds are $1 million as well. These are really the points we like to hone in on here. Your capital gains on that, you'd have about 276,000 in taxes due from the transaction with sale of this asset, which would leave your funds available for reinvestment after at about 724,000. Versus if you structure and actually participate in a 1031 exchange, all of your proceeds are moved forward. So that really, as we think about moving forward into the future, that gives your money the ability and your real estate the ability to really compound and appreciate in value. Next, we'll just go into a couple of reasons to consider a 1031 exchange investment. And this is where we'd really like to jump in. One of the major benefits of a DST is when a DST is structured and offered interest out to investors, the real estate is already closed upon, permanent financing is already in place. So if you're selling, a building, you want to exchange into another building, you're worried that you're not unable to close on that second building, a DST, a sponsor will already own the real estate in that offering. So, considering a DST or identifying a DST gives you a really good parachute if something goes wrong with your other identified properties. Most DST investments are admitted into the trust within 24 to 48 hours, meaning that you fill out 20 to 30 minutes of subscription documentation, work with your QI, and those funds will be sent over to the DST sponsor and it'd be admitted into the fund. And next, what it really does too is it really reduces your risk of blowing an exchange. So say, an example we see often is you identify 3 properties, you really wanted one, but something goes wrong. It falls through with that first one. And what happens then if you can't close on the next 2? You might be staring down, say a $4 million, tax liability that you weren't anticipating. In a situation like that, if you were to consider or, identify a DST, if everything else goes wrong with all your other properties, you'll know you at least have a parachute or a backup that you can say, put all those proceeds into this DST. I'm still getting, modest, predictable income with a good real estate allocation, and I'm not going to have to pay all those taxes. Next, we'd like to just jump into leftovers exchange proceeds. We're seeing this more and more and more that in an exchange, folks are selling highly appreciated real estate, and what they can replace in the marketplace leaves a differential and leaves leftover. Historically, we've seen CPAs and commercial brokers and a lot of those individuals. Those didn't know about another option. So now what you can do is if you have exchange proceeds left over, the minimums are down to 50,000. So say you have 200,000 left over, what you could do is you could allocate 100,000 into 2 different asset classes. And then last is just the ability to exchange back into active property management. One misconception that we've seen a lot on with a DST structure is that it's kind of end of the road for your exchange. If you've always been exchanging along, you go into a DST, you'll never be able to own real property again, and that's false. A DST is considered like kind of replacement property, just as real property. So if you make a DST investment, when that DST investment goes full cycle, you'll have the opportunity to again identify 3 more properties. Those could be real properties, those could be more DSTs, or a combination of both. And next, we'll just hand it over to Brandon, and Brandon's just going to go over a little bit about Keystone and who we are, and we will dive into that.
Thank you, Dan. Appreciate it. Rick, is audio okay on my end?
Yeah.
Yeah.
You're good.
Sounds great. Okay, perfect. Thank you. Well, as Dan has dived into what is the DST, kind of what we see as far as the economics go on a day-to-day basis. Dan did mention that we talk to a kind of a myriad of a lot of different people, advisors, direct investors, RIAs. We have some institutional interest as well. I think what what a lot of those investors are flocking to, regardless of their individual circumstances, is that it is a much more flight to safety we've seen, and net lease really provides that for, if you are building out a portfolio for an individual DST portfolio, a lot of that does have net lease at the bottom, kind of as the base for the protection of the principal. So let me jump in here real quick to who is Keystone. I'm not able to. There we go. Okay. So when Keystone was created, it was created by Mike Packman. His background, he was an advisor for 20 years, which kind of creates an interesting dynamic when you are creating a sponsor. You know what you're looking for, you know what you're, more importantly, probably not looking to provide to direct investors and to advisors. So when Mike was building the company, he wanted to really focus on all tax advantage real estate. So that's what we kind of hang our hat on. Most of our offerings, all of our offerings right now have some type of tax advantage to them. And then kind of on the flip side of that, he was working with ultra high net worth individuals, and a lot of what they are looking for is obviously they have tax issues, but also looking at philanthropic issues as well. So our tagline for Keystone is doing well by doing good. We feel that these DSTs, these other land programs that we do, really kind of hit the mark there as far as doing well by doing good. So we have nationally recognized brands, as Dan has already mentioned, Sherwin-Williams, Quick Trip, we have some Dollar Generals. So obviously all of those are going to be highly credit tenants. And in top MSAs are metropolitan statistical areas, areas that such as, Orlando, Dallas, Fort Worth, Lansing, Michigan is outside of Lansing may not be a top MSA, but it has one of the largest universities as by enrollment, which is Michigan State. Very, very close. They provide a lot of business there. Okay. It's not letting me. Okay. So really, why net lease? As I kind of mentioned, net lease is a great kind of bottom of I don't use bottom as it is the base of a DST portfolio. You're looking at principal protection. You're looking at yields that are going to be paid monthly. You don't have to really worry about any type of, the yields or the distributions not being paid. As I mentioned, the nationally recognized brands are here to stay. There's not a lot of fluctuation in and around kind of where they like to be positioned, them being able to renew leases, being able to pay their rent on time. Credit tenants, very predictable. And, as the top growing markets, I kind of covered this in the slide before. And, we're looking at long-term leases here. We're looking at 10-year leases on both of our particular DST offerings. And these are some of the top markets, top MSAs that I was mentioning. Our two current offerings right now is in Orlando, Florida, and our second one is in Lansing, Michigan, which doesn't have a star on here, but we have covered all of these that have stars on them right now. We do have properties in each of those markets, those top markets. And from our previous DST 1 and 2 offerings, which were portfolios, these two offerings in the FedEx Lansing and the Orlando Pharmacy Operations Center are both in our single tenant in our current deal. So those are individuals as well, individual deals. So with as far as suitability goes, who is qualified to invest in our DSTs? Anyone that is seeking passive real estate ownership, we have a lot of our clients and a lot of our direct investors have held real estate for 20, 25 years. They are either uninterested in continuing to either pay somebody to manage that and still have the headache probably, or they're managing it specifically themselves and it just has become either cumbersome. Also, it could be that somebody has passed away, has passed that down, and of course the children or the heirs are across the country and don't want to deal with a particular property that is uninteresting to them. So that is where a lot of people start to look at DSTs for a passive ownership. Still everything, they still love real estate, they know real estate, and that's where they want to stay, but they want to turn over that really managing of the real estate to a sponsor such as Keystone. Obviously, Dan covered the deferral of the capital gains, which is probably the number one reason you go into a DST or you do a 1031. You have no interest in paying the tax. Why work that hard to essentially write a second check, one to the IRS, and the second if you are going to purchase another property of some sort. And then, the potential of capital preservation. I think that there's you've got to really look at what you're investing in here. I think that there are definite DSTs out there that may pay a higher yield, but you've got to look at back end capital preservation. Is there really going to be is your capital being preserved at the end of the day when there is a liquidity event in 7 to 10 years? Something that probably doesn't get as much of a consideration as it should. And then predictable monthly income with net lease, it's there on a monthly basis. So let's jump into both of our current offerings. We'll jump into the details. I am a storyteller by trade, so I kind of like to, these numbers are great. You guys can see the numbers. I'll still go through them, but I like to be able to tell the story of how we came about this, why it's good, why it's a pharmacy operations support center. So this is a Walgreens pharmacy operations support center. This is not a standalone Walgreens where you're going to go in and you're going to grab your prescription and a bag of chips and get out of there. Walgreens Pharmacy Operations Center in Orlando, Florida. It's one of 4 of these particular call centers that are nationwide. This is specifically the Southeast headquarters for the Pharmacy Operations Support Center. Walgreens has been in this property for 10 years. As you can see on here, it's an investment grade of BBB. One of our real estate guys that put this deal together lives in Florida, knows the area very, very well. It's kind of a leg up. He said that this is an interesting little corridor, that it is mostly industrial in this area, and loves the particular asset. And So the reason that Walgreens has been in this property for 10 years, we bought it from Walgreens. They needed to add cash to their balance sheet, and so they sold this building to Keystone. There are licensed pharmacists in this building. So let's picture, let's say 5, 6, 7 years ago, you're walking into a Walgreens to pick up your prescription. You get home, you have some type of questions. You didn't ask whether or not you can take this particular prescription with something else that you forgot that you were taking. Or you need to know what the dosage is there, which is typically on the label, but some people don't read or didn't ask the question, and they need to get a hold of the pharmacist back at the particular pharmacy that they picked it up. Or they've got to go back into the pharmacy, sit there and wait for their number to be called again. They can immediately jump on the phone. There are pharmacists there on site at this location. And they can get everything answered just like it would be there, and they have access to their records, so they would be able to see exactly what they have been taking in the past. So, what this does, yes, it's a pharmacy operations support center, but having these in place, having these 4 pharmacy support centers in place, it allows those pharmacies, the Walgreens, as a standalone pharmacy, be able to do a lot better at higher generating activities. So you're not taking a call after you've already dispensed the medication, getting a call from somebody, 10 minutes later. They can go on to something else. So it is really Walgreens kind of control that a lot more. Some of the numbers here, it's a $22 million offering. 38 million is the total offering amount, and then you can see that the debt on the property is $16 million, and then the loan to value, the LTV, which is always something that usually somebody that's going into a DST or a 1031 typically knows how much they need to look at investing, and their LTV of 42%. We're a little under 42%. Minimum investment, as Dan mentioned, is $50,000. And one thing to note, we have a incentive program that is going until the end of August, so Labor Day weekend. Our cash flow on this property is 4.5, which is up 0.4 basis points, and that is, we did this incentive program right before Memorial Day weekend, with just the challenges of being so much equity on the market across a lot of different sponsors, across different DST options. There may be, let's call it 50 major sponsors of DSTs. And there may be, let's just say that they each have 2 to 3 offerings on each platform. That is a lot of equity that's sitting on the table right now. The investors really kind of have the upper hand. They can kind of be a lot more choosy than they used to be in the past. So this incentive is to just drive a little bit of interest, drive a lot of interest, in fact, over the last 6 weeks. How that works is, typically, and you'll want to make a note when you're looking at other offerings, we are paying the upfront fees for the investors for both of these offerings through Labor Day, which increases your cash flow in perpetuity, meaning until we have a liquidity event at 4.5, and that is on the Orlando Pharmacy Operations Support Center. So this is a 10-year fixed interest only non-recourse loan, and this is a triple net property.
Yeah,
so
just one thing. Just to jump in on, just one clarification too. This property is actually pretty neat. It does have a rent bump as well. So year 1 through year 5 is 4.5. At year 6 to disposition would be 4.62. So,
Understand. Yeah.
Yep.
Awesome. And we can just jump into the next one. Great. So this is the FedEx Ground Distribution Center, Lansing, Michigan. As I mentioned, it is a 147,000 square foot building. This was bought from one of 5 merchant builders that builds exactly a nationally preferred builder for FedEx. This is a huge industrial growth area in Lansing. There's a big loop that goes around Lansing. It's on the western side it's in East Lansing, if that makes sense. And what was included here, or what's around this particular industrial plant, is a 3.4 million square foot assembly plant that was just built by GM, and that was in the last couple of years. And then within a mile of this particular property as well is Amazon has a fulfillment center. Ryder Transportation has a fulfillment center, and it has a distribution center, and so does Meijer grocery stores. Meijer is kind of more focused in the Northeast. That may not be familiar to some of you. A couple of stats on Lansing, Michigan, if I may. So Lansing is within 250 miles of Lansing, Michigan. You can reach 40 million people. And it seems like that stat doesn't make sense, but from Lansing, Michigan, Chicago, Indianapolis, you have, Columbus, Ohio, Detroit, but also going back across the Ambassador Bridge, which is only a 90-mile drive from Lansing. 25% of Canada's $700 billion annual trade comes across that bridge. So it doesn't really take into account everything that is across the Canadian border, which is the largest border crossing into North America. So the LTV on this is right at 40%. I think it's just a little under 40%. It's a $17 million equity offering, and just under 30 million is the total, with a little over $11 million in total debt. Same. It's a 10-year interest only, and it is non-recourse as well. For the yield increase, the incentive on the yield goes from 3.5% to 4%, and that's until Labor Day as well. And it looks like, I don't know if we have any questions down here in the chat.
No. One thing I just mentioned too, there's a couple QR codes here, and if you want additional information, we can share the slides too as well. And then just one thing I'd like to clarify on this as well is, goes back to one of the points we were discussing earlier, is that these properties are fully closed on and purchased and put into the trust prior to just being offered out to investors. So we'll actually purchase and acquire this real estate, put permanent financing in place, that 11.3 non-recourse status permanent financing, and then offer the interest amount here out to there. So that's one point of clarification we'd like to just bring up to folks as well.
It's not a blind pool.
Nope. And let's see here. All right. Let's go through. Looks like we have a couple questions here. Okay, so one of the questions here that we see, it's regarding the LTV rate. And so the LTV is essentially the loan to value. And it gets into a question about if you purchase in a certain amount, you'll get allocated. So really how that works with a DST investment, and we'll go up one more slide just to explain this a little bit better. How this works is when you make a DST investment, you're purchasing in, you get a portion of equity allocated to that and a portion of debt allocated so you get a portion of the debt allocated from the debt pool here and a portion of the equity as well at that rate. We're happy to have, an online offline conversation too, as well as if you have, say you're selling a replacement property that's maybe in the mid 50s, what do you do with that? There are some different strategies that you can use to either add fresh cash to those or blend with another higher LTV offering as well. And those ones we're happy to do any of those kind of projections and some of those, initial modelings as well as if you have, any questions on those. In the next, I see a question here, Brandon. It says, if my client has all cash exchange, would they be able to invest in a leveraged DST? And that's a great question there. So you are. Really the suitability is just you have to be an accredited investor to invest in these since they're private placements. But if you are an all cash investor and you did want to make an investment in this, it may make sense, and we can accept those investments as well. And it may make sense because if you've depreciated your full basis in your relinquished property, adding debt in an exchange gives you an additional basis to depreciate and make that income that's spun off from that DST investment more tax efficient. That's not as applicable on the Walgreens side, being a tax-free state, but on the Lansing side as well, it gives you that. Plus, just broadly, your income, if you have more depreciate, that's more, will make your healthier return and offset other forms of income that you have as well. Let me see here. I think that's what we have. Is there any other questions that we have here? That doesn't look like there's any more.
I think you answered those two.
Yeah. Oh, and one thing I just forgot to mention earlier, my apologies, is Mike Packman, Keystone's sole owner and CEO, is actually the 1031 exchange expert and contributing member for the New York Real Estate Journal. So Mike's wrote extensive articles in there about the benefits of 1031 exchanges, current, the marketplace and current different topics and articles surrounding around real estate. So if you ever have any questions on those or want to review any of those, please feel free to reach out to Brandon or I, and we'll be happy to circulate.
Okay. Thank you, Dan. And thank you, Brandon. Quite a bit of information. And like I said, if you, I know this has been, it's kind of a tough day for people to come onto a webinar because it's the long weekend. Everyone's in a hurry to get their 4th of July started. But, and I appreciate the two of you giving up your time on the 4th of, this long 4th of July weekend, the beginning. Like I said at the beginning of this, that we will have this up on our podcast, NEREJ/NYREJ podcast, starting probably tomorrow, so people can enjoy this over the long 4th of July weekend, sit at the beach and listen to this. But if you missed it or you have friends that have missed it, and it will also be through our social media telling people that they can come and listen to this as well. You can go to our Google podcast. You can go to Spotify. You can listen on Amazon Music, Apple Podcast, Buzzsprout. There's probably some more that I'm missing, but it's most of your podcast platforms. You will be able to listen to the podcast, and also will be on nyrej.com/videos. As far as if you would like to watch it, you could see the whole presentation as well, and it will also be on our YouTube channel. I want to thank everyone for joining us today, and I hope you all have a safe and happy 4th of July.
Awesome. Thank you,
Rick.
Rick.
Appreciate it.
Thank you.
Sir.
Mhm.